we had job openings for the month of September. They fell to a 3-year low of 7.44 million. We're also getting the latest reading out on the consumer confidence coming in above expectations. The reading there for the index at 108.7. I'm curious, does this at all influence, or what is your biggest takeaway from maybe what this tells us about the health of the economy at this point?
Well, I think the JOLTS report is actually quite informative. It does show that there is much less tightness and continues to be less tightness over the past 3 years. We've seen job openings come back down to levels that are close to what they were before the pandemic. But importantly, in this report, we saw a slight rebound in the hiring rate, which shows you that essentially the floor is not falling under the labor market, but instead what we're seeing is a gentle cooling of labor demand and less labor supply absorption. Nothing catastrophic, but still this gentle softening of labor market trends. And in terms of confidence on the consumer front, consumers are not one homogeneous group. There are multiple elements, multiple tranches within consumers. We know that those at the lower end of the income spectrum are facing more difficulties when it comes to spending in a high price, high interest rate environment, but those at the higher end of the income spectrum are still spending relatively freely.
Greg, does this at all change, I guess, the calculus or your expectations that heading into Friday's print?
Well, I think generally speaking, we're going to have a very muddy report when it comes to the employment report. As you know, there were a couple of strikes that distorted the numbers, and there were also a couple of major hurricanes that likely distorted the payroll print. So we're anticipating a payroll print around 60 to 70,000 jobs being added over the month of October, but disruptions that are likely to be worth around 100,000. So maybe the underlying pace of the labor market right now is around 175,000 jobs per month, but that print on Friday will be extremely muddy. And I would caution anybody trying to over-interpret those numbers. You'll see markets trying to analyze and overanalyze the data as to what the Fed will do, but I would be very cautious, especially with this extremely muddy employment report.
Yeah, and Greg, this is something we were talking to our markets reporter Josh Schaefer about last hour, just in terms of the emphasis we in the media obviously love to play up, and rightfully so, these big releases. But in terms of how closely the Fed tracks these single data prints, what is your interpretation of that, and just the likelihood that they will then maybe be more likely to just look beyond this noisy print?
I think we should be very careful with the data that we're going to get over the course of the next month because of those disruptions. When it comes to the data prints this week, we'll get a read on GDP growth in the third quarter, which was likely robust, around 3%. We'll get a read on PCE inflation, which is the Fed's favored gauge of inflation, which likely moved closer to 2%, which is the Fed's inflation target. And then we'll get this muddied employment report. When it comes to what the Fed is likely to do, I think there are different groups within Fed policymakers. There are some that are seeing the latest data as an indication that perhaps they should slow down the pace of easing monetary policy. But I think the core of the Fed, which is still led by Powell's influence, is of the view that a gradual easing of monetary policy is optimal if you have a forward-looking perspective which captures disinflationary fundamentals and gently easing economic momentum. The goal is to neutralize the effect of monetary policy on the economy ahead of time, not be excessively reactive, as was the case over the prior 2 years.
So, Greg, we have the latest that's going on the labor front, obviously very important, front of mind for investors, for Fed, for economists who are trying to figure out what is next. I'm curious just to get your thoughts on inflation, though. Is inflation as under control as maybe the markets are pricing in or anticipate at this point?
Yeah, I think generally speaking, we've talked about this in the past, and I've highlighted that you should really focus on the underlying fundamentals when it comes to inflation. The process of disinflation is extremely bumpy because you have these monthly occurrences that disrupt economic activity and disrupt inflation readings. But if you look at the underlying fundamentals, which are 1, consumers are being more prudent with their outlays. 2, businesses have less pricing power. 3, wage growth is moderating. And 4, productivity growth is still quite strong, easing some of the inflationary pressures. Take all of those factors together, along with gently easing rent price inflation, then you have all the right ingredients to move us closer to 2%. Are there risks to the upside? Of course there are. The Middle East situation and rising oil prices are just one example, but transportation disruptions, supply chain disruptions are another example. So yes, risks are tilted to the upside, but the underlying domestic fundamentals are pointing towards further disinflation, which should allow the Fed to recalibrate monetary policy.
So, Greg, what do you think the Fed should do then next week? Cut by 25?
I think generally speaking, a gentle and prudent approach to monetary policy would be the optimal way forward in this highly uncertain environment. We haven't talked about the elections, but there's tremendous uncertainty as what the policy outlook could be post-election. Those risks make the case for a gradual and steady easing of monetary policy. You may recall that a few years ago, Powell had talked about navigating a dark room and feeling your way through this dark room. I think this is very much the time to adopt this prudent approach of gently easing monetary policy, and 25 basis points rate cut would be optimal, in my opinion.
All right, Greg Dacko, always great to get your insight. Thanks so much for joining us here this morning.
Thank you.